Good afternoon, everyone. Today I'm chatting with Jay Martin from The Jay Martin Show. In today's discussion, we get into the current state of the Canadian economy and where it could be heading, the idea of governments investing in mining and whether that's necessary and how we can expect it to work out. And we get into how to invest in mining at various stages of the bull cycle, bear cycle, or whatever happens in between. All right, everybody, enjoy the conversation. Jay, it's great to see you again.
Steve, it's great to see you. Thanks for having me back.
So we've been talking for a couple of years, and I know you've been bearish on the Canadian economy, or at least your outlook for it. So I'm curious if that's changed at all and sort of what your assessment is right now of Canada's economy.
Oh man, that's a deep question. So yes, I have been very bearish and I have been divesting from Canada for the last few years. And for me, what that looks like is divesting my personal attachment and life from the country. And so we've done things like, begun planting roots, mainly in Indonesia. We pulled our kids out of the Canadian school system. They're enrolled there now. And that became a second home for us about 4 years ago, which we cemented over the recent years. So that's been where I'm at. And it's really because, Steve, Canada's a great country. It's a very simple country. And when managed properly, has amazing potential. And the evidence of that is if you look at how Canada came through the GFC in 2008, Canada came through with a healthier balance sheet than any other G7 nation because it was managed properly. But it's a simple country. We have one core industry that we do extraordinarily well. That is natural resource extraction. And if that is allowed to thrive, then all sorts of other ancillary industries can thrive as well off of that cash flow trickle that comes in from our bread and butter. But if you vilify the bread and butter, nothing else works. And that's where we've been for the last 12 years. And we've seen examples of this in history where a country does have all the right ingredients, but gets management wrong. And it can cost them, in the case of Argentina, like nearly a century of productivity, right? If you go back to the beginning of the 20th century, Argentina was one of the wealthiest countries in the world. And most people knew the term, the wealthy Argentinian, right? They had an amazing natural resource industry, both hard commodities and agriculture, and a long coastline to export. And they were thriving. But post Great Depression, they elected a socialist government that promised to intervene and fix all of their problems. And it cost them 80 years of productivity. They had all the right ingredients. They were abundant prior to, but they made a couple wrong choices politically, and it cost them a couple generations. So that was my concern with Canada, right? I was like, I don't know if the voter base is going to help us correct course here, because that's what it takes in a democratic country, which is, the best kind to live in, but there's downsides to it. And one is that you elect leaders based on short-term promises, right? We incentivize our leadership to offer us short-term promises. And anybody who's accomplished anything worthwhile in life knows that, that the accomplishments that you're most proud of that have actually changed your life for the better and added prosperity to you, those were long-term gains that always came with short-term, medium-term, and sometimes even long-term pain to get there, right? But you put the work in for the end result, right? Whether it's, you're trying to build a business, finance a comfortable retirement, run an ultra marathon, whatever the goal is, in order to get that long-term gain, it comes with short-term pain. But no politician is ever going to get to the podium and promise Canadians, or Americans, by the way, that, look, guys, if you elect me, the next 6 to 8 years are going to be really tough. It's going to be hard. But on the other side of that, I think we're going to come out as one of the most wealthy countries in the world. You got to bear with me for 6 to 8 years, but we'll get there. Nobody's electing that person, and nobody's re-electing that person in 4 years when you're in the depths of the pain. We elect the candidate who promises to make our life better next year, which is just not a possibility. That doesn't make any sense. But as a consequence, my concern was that Canada would continue to be trapped in this cycle of virtue and short-term promises. Now, I didn't vote for Mark Carney, but I have to say, Steve, he's surprised me to the upside. And I do think he's a seismic improvement on Justin Trudeau. I do believe that. So I'm actually less bearish on Canada today than I was 4 years ago. I'm still hedging my bets. We just got back from Indonesia 2 weeks ago. And, my family holds American passports. We're always shortlisting cities in the US. But that's where I'm at on Canada today. Better than I was 4 years ago, but still uncertain.
All right, so you mentioned Mark Carney and how he surprised you to the upside. He has created this major projects office where they have highlighted 11 projects that they really kind of want to focus on and make major priorities to move forward. On the mining side of that, we got five. We got the Mattawinnie project by Nouveau Monde, which is graphite, the Crawford Nickel project in Ontario, that's Canada Nickel, McIlvenna Bay, that's foreign mining in Saskatchewan. We've got the Sisson tungsten molybdenum mine in New Brunswick, and then the Red Chris extension in the Golden Triangle. What I find particularly interesting about this, and you recently did a video that I thought was great about how China really positioned themselves. And you use the analogy of, well, if we think about countries investing in themselves, like steroid use in pro sports, then it really can sort of supercharge an economy. And when we think about that, and we think about how we got these Canadian mining companies that even outside of gold and silver, they're trying to create battery metals to sell to the rest of the world. But China's able to do that cheaper because they've got worse labor relations. They got end users to sell it to if they can't. And they got a command economy where the government, if they want something to happen, it's going to happen. Now, the part that I really liked about the major projects office and what we've heard so far, and I know the conservatives have been critical that they haven't done enough, but the thing that I really like that I'm seeing there is that they actually did an offtake agreement with Nouveau Monde for graphite that kind of puts a price floor on 30,000 tons a year that really kind of reduces the risk. I'm curious here if you think that that's a good idea for Canada in terms of trying to get mining going, the idea of price floors on certain commodities, and sort of what your viewpoint on the major projects offices thus far.
I've got two answers for you, Steve. The first would be that out of principle, no, I don't think it's a good idea. I think when the government mixes with private business, it's it often turns out like somebody trying to land an airplane with a sledgehammer. Like it's often destructive and disruptive. And having said that, nobody cares what I think in our political offices. And so this is what's going to happen, whether I like it or not. I think we're going to see a lot more government intervention into private enterprise. And, there's a handful of reasons for that. Some you outlined here. There's now 60 metals on the critical metals list in the US, right? And that's up from 25 in 2018. We've nearly doubled it, right? At that rate of inflation, we'll have the whole periodic table under the critical elements list in the near future. And that's just to say that, in the West, we've woken up to our dependency and that contract that we signed with China, where we wanted the advanced tech, we wanted the end results, we wanted to design these, EVs, iPhones, and flat screen TVs here, but we didn't want the dirty part of the supply chain where we extracted and refined the minerals. And so we outsourced that to China, who see to their environmental concessions and leveraged the cheap labor and allowed us to have the things we wanted. 30 years later, we woke up, we looked at that contract. We don't like it anymore, but we signed it and it was to our benefit, by the way. But now things have to change. And I do think things have to change. And if you step back and look at countries like corporations and the globe as a competitive marketplace, then you look at, and I tend to package Canada and the US sort of in one theme here when it comes to this subject of, what I'll call state capitalism and government intervention in the extraction industries. Because Canada is following the leader, I believe, and the U.S. is leading in the West. But they're leading this direction because this is the strategy that their number one competitor, being China, leveraged for 30 years. China very effectively juiced their key industries to give them a competitive advantage. There's pros and cons to this. A lot of capital was wasted. And it's to be determined, I think, if this has true longevity over the next 30 years. It did for the last 30, but I have a lot of questions about the next. Regardless, the marriage of private-public corporation is what got China from a nation of poor rice farmers in the 90s to the top contender for global supremacy and leader in advanced technology against the US. So in the West now, we're looking at that policy and adopting it. This is now, it seems like every week we see a couple $1 billion deals out of the US in the extraction industry. And these aren't subsidies or loans, they're often equity deals, right? Equity stakes in US antimony, Lithium Americas, equity stakes in Intel. The Department of Defense is now the largest shareholder of MP Materials. Trilogy Metals up in Alaska, right? A Vancouver-based mining company with a project in Alaska. And we're seeing the US government and departments of this government take equity stakes in these deals. And, we're going to see similar activity in Canada, I believe. Now, like, again, I'm not in favor of government intervention in our industry, but it doesn't matter because I do believe that it's coming. And I feel two ways about it. And frankly, they're both bullish, to be honest with you. Number one, we get back to what's Canada really good at. It's that extraction industry. The core problem in Canada for the last 12 years is that we've had a political establishment that vilified that industry, overregulated, overtaxed, and prevented Canada from leveraging our core strength, which is the natural resource sector. If we now have an establishment in place who's actually pushing that industry forward, it's very bullish for commodity investors. I mean, I think the Nouveau Monde share price took a nice jump after that deal was done.
50%, yeah.
There, so not bad, right? But look at the Trilogy Metals deal in Alaska, right? The key issue with that asset was access. You could only get there by air. There was a road that Biden didn't want to build. Nobody wanted to build. A couple $2 billion, lots of environmental destruction. But after the U.S. government took that stake in Trilogy Metals, they then coordinated the Bureau of Land Management to get that multi-billion-dollar road built, the Ambler Road, up to that project in Alaska. The point there is that there's a new stakeholder at the table in the commodity sector. They are an activist investor, one that has very deep pockets, but also one that can shift policy to the favor of the natural resource sector. And that's happening now. So, I don't think it'll be a perfect execution here, but I think we're going to see more of it, more government intervention, funding, and facilitating the advancement of these 60 key materials on the critical metals list. I mean, start there, So, also governments are going to be reckless with their spending. That's not going to change. I mean, Carney's new budget is incredibly expensive. But if anybody was expecting a fiscally responsible politician to show up, like what have you haven't been paying attention, right? Canada or US, that game's over. We're only going to get excessive spending and devaluing of the currency in the future. So that being the case, I do think it matters what that debt is spent on. And, in that sense, you have a bit of a case study between the United States and China, right? Where you could look at money borrowed over the last 30 years and what that money was spent on. And you'll find that in China over the last 30 years, they borrowed about $40 trillion. But with that cash, they built the most specialized economic manufacturing zones that the world's ever seen, with refineries built right next to component makers, right beside deep water ports or heavy rail. And they built a machine that can produce more efficiently at a lower cost than anywhere in the world. The United States borrowed $31 trillion since 2001, and they spent that money funding foreign wars that they lost, bailing out banks for fraud, and financing stimulus programs that were often spent on buying goods manufactured in China. So at the end of the day, it's like a similar picture. One country bought assets and cash flow, and the other country bought bad memories, right? Like, so it's not as simple as reducing it down to debt to GDP or all of this. And so if this is the shift in policy, it's not the one I want, but it's better than what we've had for the last 12 years.
And I fully agree with that, and it may sound like a little bit of a cop out, but if we're going to be spending money and taking on debt, it's a heck of a lot better to put that into something that's end result is going to be selling materials to the rest of the world than say $12 billion in gender programs, which the Winnipeg Sun reported that Justin Trudeau spent over his tenure. And that's a lot of money. Canadians lose sight of how much money that is. NextGen, which has the most exciting uranium project that's in development right now, if you go and read their feasibility study, it's expected to generate $5 billion in tax revenue over its lifetime. And here we're just handing $12 billion abroad for
Yes.
for gender rights. And I think that Canadians lose sight of the value of the dollar. And when we think about in terms of how we want to spend stuff, you're exactly right. If we're going to take on debt, if at least we end up with a productive result where we're going to offer the rest of the world value, it's a heck of a lot better than, say, just adding more debt to the balance sheet and ultimately not getting any return out of it.
100%. And you can't really fault people for having that obscure view of the value of money when our leadership is leading that way, right? I mean, this $12 billion for gender language or whatever you mentioned there, like that's coming from the leadership, right? So people, of course, are a bit disillusioned with the value of money because from the top, that's what they're seeing, right? One way I encourage people to think about this, and this might be a bit far-fetched or even controversial, but to a degree, Steve, we're seeing, starting with the US governments and now Canada, they're adopting my investment strategy and probably yours, right? And Rick rules. They are swapping fiat currency for hard assets. That's what's happened with those equity deals, all the metals deals we just walked through, And so, look, I mean, whether or not that works out, I think it's affirmation that we're in the right spot, right? And I think it's very bullish for commodity investors.
Jay, since the last time we spoke, gold has been on a pretty big tear. When you think about why gold is moving, how much of it do you think is the world waking up to the fact that governments just have given up on fiscal prudence?
I think people are beginning to wake up to that, but I think it's the very beginning of that general wake up. And inside the gold industry, like inside the community of people that invest in precious metals and precious metals equity, to us, it seems like we're fully on right now. The market is hot. The market is frothy. To some, it's too hot. And they feel like we're probably, I hear this often from folks once they hear any sort of mainstream coverage of our industry that we must be near a top, right? And honestly, I chuckle a little bit because what that says to me is that it's been bearish and tough for so long for gold and silver investors that they legitimately forgot what a good market feels like and looks like, right? Now you just look at a hot market in AI or crypto or cannabis back in the day. That was a different thing from what we're seeing in the gold sector today. On the margin a little bit, we're getting some mainstream interest, but not a lot. And most investors that are participating, generalist investors that are now coming to the table, are still categorizing this as they call it the debasement trade, right? And to me, again, that speaks to an investor who watched the cannabis rally, watched the AI rally, watched the crypto rally. And to them, gold's just the next asset that's taking its turn, right? And they'll get in and they'll get out. And that's what they're expecting. So they're calling it the debasement trade. But the mechanics of a trade would be that you have some cash, you trade that cash for an asset that you believe is undervalued. When that asset appreciates in price, you trade it back for the cash, right? That's how the trade mechanics work. In this debasement trade with gold, what's the second half? You're going to sell your cash because it's being debased and buy an asset that cannot be, being gold. But at what point are you going to sell that gold and go back to the debased asset? Like no one's going to do that. And so I think this will naturally kind of flush out as we move forward in this market. But the concept doesn't make any sense. And I think people are going to have to live it to realize it, that a gold market is a bit different. And, fortunately, unfortunately, mainly unfortunately, good news for gold investors is bad news for pretty much everybody else. Gold's the smoke signal, right? That's what people buy when they're concerned about something going wrong, especially if they're not sure what. They don't really know enough to form a coherent strategy. Then you jump on a lifeboat, an asset like gold that doesn't have counterparty risk, has withstood the test of time through good markets and bad. Empires come and go. That monetary assets remained. And if you don't know what's around the corner, gold's a great asset to own, right? But you don't see, central banks swapping treasuries for AI stocks. You don't see institutions, mandating 5% allocation to AI stocks as a hedge against uncertainty, right? That's gold. It plays a different role. And so we're seeing a bit of mainstream interest on the margin, but I think it's misunderstanding the market. And regardless, it's so marginal, to be honest. I speak to a lot of generalist investors, Steve, and it's very infrequent that somebody asks an intelligent question about how to allocate a bit of capital to the gold sector. And most recently, this did come up in an investment group I'm a part of. And it was just, for about a week when gold was hitting all-time highs. And then I'm getting questions from people saying, what's a good gold asset to own? And as soon as it corrected 10%, the interest is gone, right? So it's fleeting and marginal at best. As a consequence, I think we're still super early innings in that. But yeah, that's it.
So you mentioned so some of these AI stocks, whether we're talking about NVIDIA or Oracle, or we could even go sort of those S&P 10, as they're now saying, getting into some of those other names like Apple and Google and Meta. Do you think that we're going to get to a point where some of the big gold stocks become names like those, where there's this massive, rabid retail following where people really gravitate towards those best in class mining names like the Agnico Eagles and the Newmonts of the world? Or do you think that it's just always going to be traded a bit of a discount to what we see in other bull markets?
It's funny when you ask that question, because I think about what that would look like if Agnico and Newmont and Wheaton Precious Metals were, the talk of all the meme stocks and popular interests like NVIDIA today. And it's hard to wrap your mind around that world, because it's just not been the case for the last 15 years, right? Gold's been laughed at, not just like not favored. It's been, laughed at quite literally, right? So for an asset to come from that and hit sort of mainstream interest in that way would be something. The short answer is I don't know, but the longer answer would be this gold market has struck me as incredibly textbook and patient. We saw a flash in the pan precious metals market in 2020. We saw a bit of activity in 2016. But those weren't like this. This, you could say that, the seeds were kind of planted with that central bank buying back in 2021, 2022, and early 2023. And physical was being bought off the market in record numbers that we hadn't seen in 40, 50 years. And it was being bought by the slowest, most patient, most long-term money, being central banks. And the equity prices didn't respond at all. And investors were very frustrated with that. But eventually, the best-in-class streamers started to move in 2023, the Wheaton Precious Metals and the Francos. And after that, 6 months later, we saw the Agnicos, the Newmonts, the Barricks begin to pick up. But it was so slow and methodical, the way capital trickled through the sector one stage at a time, beginning with the physical, then going to the best-in-class cash flowing royalties, then the best-in-class production companies, and slowly move down to the funded developers, and then the unfunded developers, and then some exploration companies with world-class assets began catching a bid. But because it's been so slow to roll out, it's given me a lot of conviction in the legs. Often you can look at that in a market cycle. How quick did it heat up? That's an indication of how quick it'll cool down. And back to I don't think we're in a hot market yet. Inside the industry, it might feel like it sometimes, just because context is everything. And, relative to how the industry felt 8 years ago, 4 years ago, it feels very hot right now. But from a mainstream standpoint, we're not even close. So do we get to that point? It would be lovely if we did. You and I and our communities would do very well, I'm sure. But I think we've got a long way to go before we get there. And I think inside of a secular gold market that I firmly believe we're in, we're going to see seasons of denial where we feel like it's over and corrections are steep and investors lose interest along the way. And short-term thinkers get shaken out. That's inevitable in a long-term cycle.
I'm curious how you think about investing in mining with a particular focus on the juniors, which is largely what our audience focuses on. In terms of, we got bull markets, we got bear markets, we have those markets in between. Maybe that's from a bear to a bull or a bull to a bear, and sort of that criteria of what it looks like and what you sort of learned. To give you one example here, something that I recently learned the hard way is that in a bull market, things are going pretty good. And I think we were hitting basically recent highs in the junior market, say 6 weeks ago. But leading up to that, there was a whole whack load of financings. And it was every morning I was waking up, I was reading the news releases, the wires, and billions of dollars going towards all of these various earlier stage mining companies. And what I believe happened is that a lot of those are hedge funds that are looking to hedge their positions. And effectively, they take money from from the retail investor and from the market. They put it on to the company's balance sheets, and they take a little bit of a spread for providing that service. But what we end up with is the markets get kind of annihilated in the short term, not fully annihilated, but they go down substantially, which is what we've sort of seen over the last, say, 6 weeks.
Mhm.
And then we wait for them to kind of come back. And I take the view that we're at that stage right now. But when you think about investing in a bull market like what we're in right now, what are the sort of things you're thinking about?
So from my seat, I think every investor needs to get pretty clear on what your competitive advantage is, right? And I run a conference business. I run a media company with some brands in the podcast sector, and we run an online education platform called the Commodity University for investors who want to sort of sharpen their skill set in the mining sector. My advantage is people, Steve. That's what I know really, really well in this business. And so I lead with that. But, that means more than just finding the entrepreneurs who have a great track record. Start there for sure. But I want to invest in folks who have the most extensive capital networks. So individuals who can raise money in good markets and bad, and have options when they need to put cash in the treasury. So they don't have to take the first offer that comes to the table. They can look for a strategic long-term partner when it comes to raising capital. Now there's, there's maybe a couple shortcuts to beginning to figure that out. But one that I might point people to, not direct advice, but there's a handful of like incubator shops in the junior mining sector where you'll see, 4, 6, 8, a dozen companies under one management roof. And the companies are run independently, independent CEOs and executive teams, but they have collective management of some kind. One of the benefits that can occur with those shops is that you get to pool your resources. And I'll point to the organization that I think is the best in class at this, which is VRIC Capital, run by Frank Giustra, the chairman and founder. And there's about 10 companies in the VRIC group right now. And if you're looking for early stage, copper, silver, gold, they got you, right? They got a bit of everything right now. Frank's very bullish on the industry. He's got chips all over the table. But the point is, inside that office now, you have 10 CEOs who can bring their biggest problems to a boardroom with 9 other CEOs and workshop solutions, right? They can share their experiences of building companies along the way, jurisdiction risk, asset analysis, all of this, and they can borrow each other's capital networks. And so there's a lot more capital available to those companies, which brings the cost of that capital down significantly. And that's one of the core advantages. Inventa Capital is another one. Craig Perry, I think, very savvy entrepreneur, delivered a lot of value for his shareholders over the years. And this is obviously the origin of Vizsla Silver. Most recently, people know that deal. But another one, smaller, 3 to 4 companies under that umbrella, but they get to pool each other's resources, executive experience, and capital networks. And so they don't have to take the first hedge fund that comes to the table because cash has been so scarce for so long. I kind of understand it. It's not in the entrepreneur's best interest, but cash has been so scarce and hard to come by for so long that now there's suddenly a surplus at your desk. Entrepreneurs are tempted to take it, right? And not think long-term so much. And so we are seeing a bit of that mistake and a bit of an overhang as a consequence. But if you stick with those groups, Dolly Varden, I think, put away like $80 million in a bear market, right? They have the ability to raise capital, good markets and bad. And so when good markets come, they still have those options and they can be a lot more strategic with who they take cash from. It's very important.
Yeah, I was having that conversation the other day with a friend about how the longer you work in this industry, the more you realize that there are those little successful groups. And when you said that, one of the other names that came to my head was Inventa Capital, and I could think of a few other ones. Oh, won't get into that right now. You've been generous with your time here. I want to ask you one last question here. You mentioned your edge and your line of business. I think it's been a pleasure to watch you grow as a content creator. I think you're really hitting your stride right now, making some fantastic content. And I'm curious, as a content creator, when you think about making financial education content and trying to get better at it, and you're chatting with your team about what is it we need to do to have content that's going to deliver and make our audience happy, what's the main focus and criteria right now you guys are thinking about to make content that's going to travel and achieve its purpose?
First of all, thank you for that comment, Steve. I really appreciate that. And that's a two-way street, man. I love your show. I'd say like where we come back to is We try to simplify narratives, right? Every day we are awash in hyperbolic and sensational headlines that often mislead us or misdirect our attention. If you dive beneath the headlines, whether it's like trade aggression, any of these import export taxes restrictions that we're seeing in the trade war, regional conflicts, military activity in new spots like the Caribbean, if you dive a couple layers deeper, what you'll almost always find is it comes down to the supply and demand of resources. That's what's driving most of this activity. That's my firm belief. So being that that's the case, we try to use that as a filter for how we look at everything. Who has what and who wants what behind this situation that's developing. I think that's at the core of most sort of monetary and fiscal policy, and at the core of most geopolitical developments we're seeing today. And then, so that's one filter we use is if we look at this situation through the lens of supply and demand, how does it look? What changes? What becomes clear? And what kind of noise just dissipates and vanishes? And the second, from a geopolitical standpoint, we do tend to analyze most developments from, we use the analogy, if the world was a global marketplace and countries were competing companies, how would this marketplace look? And we use that as another litmus test. So, and that primarily is, a competition right now, a corporate competition between the United States and China, and whatever other conflicts we're seeing in other parts of the world, whether it's the Middle East, Europe, the Caribbean. Let's look at it through the lens of US-China competitiveness and see if we see it a bit differently, right? And often we do. So those two filters would be our primary for how we try to interpret what's happening and then provide a bit of clarity to folks who are interested.
So Jay, if our audience wants more of your content, I know there's the Jay Martin Show on YouTube, which everybody should be subscribing to, but you've also got a conference too. What can you tell us?
Yeah, we're back with the Vancouver Resource Investment Conference, January 25th and 26th in Vancouver. It's a just Super Bowl of junior mining investment intelligence. I've got 6 stages, about 120 keynote speakers we fly in, and around 10,000 investors attend who are looking for opportunities in the mining sector. An exhibition hall with around 300 companies looking to tell you their story. So if you're looking for your edge in this sector, it's a great place to be. What's super fun about it, Steve, is that, all these personalities that come on your show, come on my show, they're there and they're super keen to reach down to the next generation of investor coming up in the industry and share what worked for them. I mean, that was my biggest takeaway when I first got in this business. I was shocked at how generous all the veterans were with their time and their intelligence. And that is what we focus on that pretty extensively at VRIC. I make sure any of the keynote speakers we fly in, they're not there for their talk and then they're out of there. They know they need to be on the floor. They need to be at the dinner receptions. They need to be hanging out and taking pictures and signing autographs if that's what people want, but more just asking questions mostly, And so it's a great sort of community vibe. It's grown a bit in the last couple of years, but it's still retained this great community vibe. And, in advance of that, we have an online education platform called the Commodity University. We built this last year. It's at thecommodityuniversity.com. There's 11 instructors, individuals like Lobo Tigre, Adrian Day, a suite of courses for anybody who's just getting started in the commodity sector and is trying to understand how to read a press release, like what matters, what doesn't, what's important here, how to interpret drill results, all this stuff, how to value a royalty company. Adrian delivered a masterclass in royalty and streaming companies. It's beautiful. And so we've got about 11 instructors, new courses every month, and then we do a monthly meetup. And so last month we had both Lobo and Adrian actually, and about 50 investors showed up, and we talk shop for about 30 minutes, and then the students are encouraged to bring the deals they're looking at. And so we just went through probably 50 companies, and myself, Adrian, and Lobo just sort of gave a green light, red light, yellow light. How do we feel about this deal and why? Next up is Don Durrett tomorrow. We're doing the same thing with the students. So if you're looking for, we built the course, Steve, that I wish existed when I got in the industry 15 years ago. That was it, right? And I met so many folks over the last couple of years at our events that were new to the sector, and maybe not new to investing, but new to mining. And they're like, I feel like I'm in the right place. I feel like this is the right sector to be looking at right now, but I don't have a clue what's going on. I don't know how to talk to any of those CEOs. And I only understand like 20% of what's being said from the podium. How do I get started? Right? That was the question I heard. How do I get started? And as you know, there's like 100 answers to that question, and they're all right, depending on your age, your risk capital, your time horizon, all this stuff. So we thought, let's build a suite of courses for that individual who can adopt the vocabulary. We can demystify all these concepts and allow anybody to walk in and quickly interpret a pitch and understand what's important, what's not, quickly see through smoke. I mean, so much of it's just like cutting through promotion, these courses, which is really, really valuable. And then getting to jam with the experts, get their thoughts on your portfolio, find out what they're looking at in real time. So that's super fun as well.
All right. Well, Jay, it's always a pleasure. Thanks so much for taking the time to do this. And let's do it again in the new year.
Love to, Steve. Thank you.
All right, everybody. Thank you for watching. If you enjoyed this conversation, do me a favor, smash that like button, subscribe, and ring that notification bell. Also, if you want more mining content, check out our website over at thedeepdive.ca.